Right now, bombs are falling in the Middle East. Geopolitical tensions are redlining. Traditionally, this is the exact moment gold is supposed to surge. Instead, it's in freefall. Before we analyze the mechanics behind this move, remember that this content is for educational purposes only and is not financial advice. Gold just fell off a cliff. We are looking at a brutal 15% drop from the recent all-time high, the single worst weekly collapse for the metals since 1983. This anomaly is the rainy day paradox. Investors accumulate gold as a specific insurance policy against global instability. It is the asset you hold for the worst-case scenario. But when that scenario arrives, equity and energy markets often crater, triggering margin calls. A margin call is a formal demand from a broker for an investor to deposit immediate cash collateral to cover mounting losses in their other positions. Because gold is the most liquid asset on Earth, desperate funds liquidate it first to stay solvent. They are selling the umbrella to pay the rent during a downpour. This economic chain reaction started in the Strait of Hormuz. Middle Eastern conflict is choking physical shipping lanes, effectively freezing global tanker traffic. This blockage removes roughly 20% of the global oil supply from the market. When a fifth of the world's energy source vanishes, prices per barrel skyrocket. High crude prices translate directly into higher costs for fertilizer, transportation, and manufacturing. The inflation that everyone hoped was cooling off has suddenly returned with a vengeance. This forces the Federal Reserve into a corner. Instead of cutting rates to help the economy, Jerome Powell and the Fed must keep them high to combat this new wave of inflation. The physical war created an inflation trap. High interest rates act like gravity on gold, which doesn't pay a monthly yield, making it less attractive while rates remain at these levels. High U.S. interest rates act as a magnet for global capital. As investors chase guaranteed returns, the U.S. dollar surges. Because gold is priced in dollars, a stronger greenback means international buyers get less metal. Global demand suffocates. This is where human logic ends and Wall Street's trading algorithms take over. Billions of dollars are controlled by code, executing without hesitation. These machines follow mathematical rules. The moment bond yields and the dollar index cross specific thresholds, the algorithms blindly dump massive paper gold contracts onto the market. This price drop forces retail leveraged ETFs to sell even more gold to rebalance their books. A self-reinforcing death spiral begins, where lower prices trigger more automated selling. Cold, pre-programmed machine logic is dictating the speed of this crash. These algorithms execute a massive sell-off in direct response to the dollar's strength. We've seen this blueprint before. In 1983, a massive global oil glut caused prices to crash, obliterating the revenue of major energy producers in the Middle East. To raise cash and keep their governments running, these nations were forced to dump their massive national gold reserves, cratering the global price. We are watching a modern version of that crisis. While oil prices are high, Gulf states cannot ship their product through the conflict zone. Their primary source of revenue has stopped. These nations must maintain their currency pegs, a policy of tying their local currency's value to the U.S. dollar. To find the dollars they need, they must liquidate their gold vaults. The weight of sovereign nations liquidating their gold is the final domino. It turned a standard market correction into a historic price collapse. To understand the future of gold, we have to distinguish between paper gold, futures and ETFs, and the actual physical metal. The panic is currently localized in the paper markets. While algorithms panic sell paper contracts, Eastern central banks and smart money investors are using this drop to buy physical bullion at a discount. The core reasons for gold's long-term rally remain. National debt is hitting records, money printing continues, and the global trend of de-dollarization is still accelerating. This crash represents a temporary liquidity squeeze. The financial plumbing is reacting to high interest rates and automated margin calls. For the patient investor, a global crisis that disrupts energy and triggers widespread panic highlights the specific utility of hard assets. Even with short-term volatility, the underlying structural case for gold remains as solid as the metal itself. If you found this breakdown useful, please like the video and subscribe for more in-depth market analysis. Thanks for watching.